Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday, the 29th of October 2020, and we're looking at the World Gold Council report published today to bring us up to date with current gold demand. So let's take a look. Now, before we look at the Gold Council report, just a reminder that yesterday we provided our gold and silver financial midweek update, where gold and silver prices had fallen and even now are still down on the week and in fact worsened since yesterday, with gold currently standing at $1,864 and silver at $22.81 an ounce. And on Tuesday, we published a video entitled Hidden Silver Treasures Rediscovered, plus Musings. And we've placed a link to this and the previous video in the description box below. Back to the World Gold Council report published today. Let's take a look. World Gold Council, dated 29th of October 2020. Headline: Strong growth in global investment demand for gold in quarter 3 partially offset weakness elsewhere as consumers battled the effects of COVID-19. Gold demand dropped by 19% year-on-year to 892 tons in quarter 3 as consumers continued to feel the impact of the COVID-19 pandemic. This was the lowest quarterly total since quarter 3 of 2009. The year-to-date demand of 2,972.1 tonnes was 10% lower versus the same period in 2019, according to the World Gold Council's latest Gold Demands Trends report. While overall demand declined, quarter 3 saw significant growth in investment demand, which rose by 21% year-on-year. Investors globally bought 222.1 tonnes of gold bars and coins and an additional 272.5 tonnes through gold-backed ETFs. Year-to-date, gold ETFs have increased their holdings by a record 1,003.3 tonnes. However, the combination of continued social distancing restrictions in many markets, the economic slowdown, and a record high gold price in many currencies proved too much for many jewellery buyers. Demand declined by 29% year-on-year at 333 tonnes, down from an already relatively anemic quarter 3 2019. Quarterly inflows of 272.5 tonnes took global holdings of gold-backed ETFs to a new record of 3,880 tonnes. While the pace slowed a little from H1, sustained inflows through quarter 3 demonstrate the continued motivation of ETF investors to add to their holdings. The US dollar gold price rose to a record high of 2,067.15 ounces in early August. This was followed by a pullback, with the price closing the quarter around $1,900 an ounce. Record high prices were also seen in various other currencies, among them the rupee, the yuan, the euro, and sterling. Bar and coin investment jumped to 222.1 tonnes in quarter 3, up 49% year-on-year. Most major retail investment markets saw strong growth. The largest volume increases were seen in Western markets, China and Turkey, in contrast with continued significant sales in Thailand. The effects of the pandemic further impacted the jewellery sector. The weakness caused by COVID-19 was compounded by record gold prices. Quarter 3 demand fell 29% year-on-year to 333 tonnes. While China and India accounted for the largest volume declines, weakness was global. Central banks generated modest net sales of 12 tons of gold in quarter 3. This was the first quarter of net sales since quarter 4, 2010, primarily due to concentrated sales by 2 banks. Buying continues at a moderate pace, driven by the need for diversification and protection amid the negative rate environment. Louis Street Market Intelligence at the World Gold Council commented, quote, "The impact of COVID-19 is still being felt in the gold market across the world. The combination of continued social restrictions in many markets, the economic impact of lockdowns, and all-time high gold prices in many currencies prove too much for many jewelry buyers. We believe that this trend will likely continue for the foreseeable future. However, looking to the investor landscape, we saw further record inflows into gold-backed ETFs in quarter 3, taking the global total to a record high. It was equally encouraging to see gold's role as a safe haven for retail investors shine through this quarter, as people continue to seek stability in volatile markets." Unquote. The key findings included in the latest Gold Demand Trends report for quarter 3 2020 are as follows. 1. Overall demand declined in quarter 3 by 19% year-on-year to 892 tons. 2. ETF inflows, investors globally added 272.5 tons to their holdings, taking global holdings to a new record of 3,880 tons. 3. Bar and coin demand increased significantly by 49% year-on-year to 222.1 tons. 4. Global jewelry demand improved from a record low in quarter 2, but declined by 29% year-on-year to 333 tons. 5. Central banks were net sellers of 12 tons, the first quarter of net sales since 2010. 6. Demand in the technology sector fell by 6% year-on-year to 76.7 tons. And 7. Total supply declined 3% year-on-year. End of article. So, looking at current demand statistics and also the advent of increasing coronavirus cases, which are rising with further lockdowns around the globe becoming prevalent, we can see that jewelry demand is likely to remain under pressure for some time to come. Also, we've published many times previously that ETFs are taking up the slack, though it is encouraging to see a rise in coin and bar demand. For how long is difficult to estimate, but the underlying signs are positive, regardless of the recent fall in prices. Now, briefly looking at Bloomberg, which has given us a slight update on positive economic data being announced in the United States, we can see underlying figures are positive, though one cannot help but ask if these are going to be the best for some time to come, or even if perhaps they've been manipulated a little in order to be amended or revised downwards next month. But regardless of these thoughts, let's see what Bloomberg has to say on the matter. Bloomberg Article dated 29th of October 2020 at 12:34 but updated at 12:41 p.m. GMT +1. Headline: US economy expands at record 33.1% pace after COVID plunge. The US economy bounced back with a record yet temporary surge of growth in the third quarter as businesses reopened and stimulus cash powered consumer spending, reversing much of the collapse stemming from coronavirus-enforced lockdowns. Just as the second quarter plunge in output was the biggest in 7 decades of data, so too was the third quarter rebound. Gross domestic product grew 7.4%, a quarterly gain that equals an annualized pace of 33.1%, the Commerce Department's initial estimate showed Thursday. The figure topped economists' estimates for a 32% increase, which was already well above forecasts 3 months ago for an 18% gain. Personal spending fueled the surging growth, climbing an annualized 40.7%, also a record, while business investment and housing also posted strong increases. While the report makes clear that the economy has found a solid footing for now, analysts caution that growth will be much more modest and choppy in months to come, especially as the spread of the virus gathers pace again, and lawmakers remain in an extended deadlock over a new stimulus package. Moreover, there are still nearly 11 million fewer workers on payrolls than there were before the pandemic hit, and analysts say a full recovery in GDP is at least several quarters away. Even with the outsized gain, GDP is 3.5% below its pre-pandemic peak, and the virus will keep business and jobs depressed in sectors like travel and restaurants. Just 5 days until Election Day, President Donald Trump will likely point to the latest figures as evidence of his ability to guide the American economy through the COVID-19 crisis. It's unclear, though, how much of an impact the upbeat figures may have on the election, especially given more than 76 million Americans have already cast their vote. Futures on the S&P 500 rose slightly after economic data Thursday morning. A separate report showed applications for US state unemployment benefits fell more than forecast last week. The yield on 10-year treasuries was little changed, and the dollar rose. End of article. So we have a modest recovery in employment and growth, but a falling equity market, with most US indices closing down yesterday by an average of 3.5%, and UK and European markets down currently between 0.5% and 1%. And Asia-Pacific markets also closed down. The dollar index has strengthened further since yesterday's rise by an additional 0.32, with the index now standing at 93.73. A major cause for the fall in today's precious metal prices. So all we can do now really is requote what we stated in yesterday's video, which was, so we have falling equity markets, precious metal prices and oil, and a rising dollar, which once again reasserts, even in this environment, that the US dollar is still currently the safe haven currency to which investors flock. We're even more concerned about silver prices because these lockdowns will undoubtedly have a negative impact on the industrial demand for silver, and we could see its price fall closer towards the bottom of our $22 to $26 range. But let's just wait and see." Unquote. Now, having said that, we're still positive precious metal prices medium to longer term, and would view price weakness as an opportunity to buy more for those who haven't met their planned quota as yet. What do you think? Do share your thoughts. Thank you so much for listening, and if you haven't already done so, please subscribe to our channel. Not forgetting to press the bell sign so that you're notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.